All right. Thank you, everyone, for joining us today for this webinar that talks about 1031 exchanges and Delaware Statutory Trust. And I'm very glad to introduce Genesis Bank, whom we work with. They're a qualified intermediary, in addition to being a regional bank in California, doing business throughout the United States. I'll let them introduce themselves. But first, a little bit about Perch Wealth. So we focus and specialize in helping investors that own real estate, investment real estate, do when they're doing a 1031 exchange to invest in Delaware Statutory Trusts, which we'll get into a bit later. But essentially, we help with that process and give people options in doing a 1031 exchange into a Delaware Statutory Trust. And the team at Genesis Bank, they can help you on the front side, which is helping on the 1031 side in terms of holding your funds. So without much further ado, it is my pleasure to introduce Balaji Krishna. He is the EVP of Specialized Banking at Genesis Bank. And Balaji, thank you. And thank you to Juno and the rest of your team for being here today and for the great work that you guys do.
Good, thank you. I'm Balaji Krishna, head of specialty banking here at Genesis Bank. We launched the bank here in August of 2021. So we're a newer bank, but our management team has been together now for a few iterations of banks, if you will. Our CEO, chairman, and founder, Stephen Gordon, launched two other institutions here in Orange County. One was called Commercial Capital Bank. He launched that back in the late 90s. Grew that, took it public along the way, wound up selling it to another institution in 2006. Took a few years off, and then we launched another bank called Opus Bank. We launched that in September 30th of 2010. And again, we grew that, took it public along the way, and sold that in June of 2020. A handful of days later, we actually submitted the application to the regulators to launch a Genesis Bank. And I bring up that date, June of 2020, because as you well know, Ehud, we were in the throes of the pandemic at that time, and we were seeing clients of ours, or not ours specifically, but of the banking system, who were kind of being left behind. There was PPP going on, but the small businesses in particular were kind of getting left behind in that process. So we knew there was a place for a bank like Genesis that could really focus on the small to mid-sized businesses here in the communities that we serve. A common thread of the banks that we've operated in the past is we've had the 1031 exchange side. It's been a very important part of our business. For Stephen, multifamily lending has been also a large part of what we've done. So the 1031 exchange side just kind of goes hand in hand with that, because again, we're dealing with, investors, if you will, and, they are obviously smart and savvy individuals who are looking to defer capital gains. So the 1031 exchange part of this was a very important component for us. And we'll talk more about that shortly here. Some of the other things that we do here at Genesis Bank, we're a commercial bank, again, working with small to mid-sized businesses. So, we offer working capital, we do owner-occupied real estate, SBA lending, treasury management services, to really help our clients, maximize their cash flow efficiency. My day-to-day bank, sort of expertise involves working with escrow companies, title companies, property managers, HOAs, CPAs, law firms, just to name a few. Additionally, we're also an escrow. We have an escrow division here. So for our clients, we can help them with their escrow needs, both for real estate transactions and then even non-real estate escrows. So subscription escrows, bulk sale transactions. So to name a few. Again, to go back to the 1031 exchange side before I hand it off to Juno, this is an interesting thing about us as a bank. As a bank that operates a 1031 exchange division. Unlike a lot of 1031 exchange accommodators that are out there, we're regulated. We're both regulated federally and through the state of California. And that's an important distinction, because the qualified intermediary space, a lot of accommodators out there, if you will, the independent ones, are not beholden to any regulators. So I think this is something that is very important for our clients to understand and to know that we are that. And with that, I'm going to hand it off to Juno to talk a little bit more through that piece and a little bit more about 1031 exchange as a whole.
Balaji, thank you very much. Once again, my name is Juno Kenny. I'm the exchange manager here at Genesis Bank Exchange. So what we've done here is I think we've created a qualified intermediary that's very client-centric, focused on keeping our clients safe and secure, both their funds and the information that they give us. One way that we do that is we open up a separate segregated trust account for each exchange that we open. Many QIs use a master account, and that leads to the potential to commingle funds with other exchangers' funds. In addition to this, all of our wires are subject to a threefold wire review. That means there's 3 separate sets of eyes that review every wire that goes out. Again, just really enforcing that the level of security and safety that we feel for our clients here. All of our documents are paperless and secure. We send everything through email. Everything can be signed electronically. This lets our exchangers, complete their exchanges from the comfort of their home, even all over the world if they need to be in that place. We use state-of-the-art exchange software here, and allows us to send our exchangers notifications and just make sure that we are up to date on all of the 1031 exchange rules and regulations. So we'll move on to the next slide there. So the agenda. The agenda today, we're just going to go over section 1031 like-kind exchanges, kind of the basics. We'll also go over the benefits of a 1031 exchange and how that can benefit you. And then Ahud will go into Delaware Statutory Trusts and the market environment. So section 1031 of the exchange, section 1031 of the Internal Revenue Code, the 1031 exchange, provides that real property held for rental or investment use in a business can be exchanged for like-kind real property. That real property also has to be held for rental, investment, or use in a business. In terms of what is accepted in 1031 exchange, all real property within the United States is like-kind real property within the United States. So it's almost easier to go over what's not eligible for 1031 exchange, and that's personal residences, real estate investment trusts, REITs aren't eligible for a 1031 exchange. You can exchange into an REIT, but you can't exchange out of it. And I won't go into that. That's called 721 exchange. Construction or fixes and flips aren't allowed in a 1031 exchange, and that's mainly because it's really a wealth preservation tool and not really a wealth generation tool. Stocks and bonds are not eligible, and neither are interested in a partnership or a business. Some of the more interesting 1031 exchange eligible properties are leasehold interests of 30 years or more. Oil, gas, and mineral interests fall into that, and fractional tenancy and common interests. So for a successful 1031 exchange, kind of a perfect 1031 exchange, there's a couple of kind of rules that you want to follow, guidelines, if you will. For value, you want to make sure that you purchase a property of equal or greater value. So that means if you sold your relinquished property for $1 million, you want to look at replacement properties around $1 million plus. In terms of equity, you want to make sure that you reinvest all the equity into replacement properties. That means all the funds that come out of the exchange, you want to reinvest those back into a replacement property in order to achieve full capital gains tax deferral. Finally, with debt, you want to make sure that you obtain a similar amount of debt. You don't want to go down in debt when you go to a replacement property. If you do go down in debt, you want to make sure that you cover that amount with additional funds that you bring into the process. So some people think that there's the term debt replacement in a 1031 exchange is common. Many people think that you need to replace debt with debt. However, you can bring in your own additional funds if you have those lying around. Not all of us do, but some of us. So here are just some examples of a 1031 exchange. You can see here client A had a successful exchange with all taxes deferred. They were able to increase their leverage to 68%. And you can see the purchase price of their property there is significantly higher than the sale price of what they sold. For client B, it was a partial exchange. They were able to do an exchange. However, they purchased less property than what they sold. In that case, you can see the difference there. They have a taxable boot of $166,667. And that's just the difference between that sale price of $1 million and the purchase price of $833,000. So advanced planning is always crucial in a 1031 exchange. One thing to keep in mind is the tax ID needs to be maintained throughout the exchange. So whatever the ownership structure is going into the exchange typically has to be maintained throughout the exchange. This means that if you want to make changes to that structure, doing it ahead of time or after the exchange is suggested. Coordinating with an exchange accommodator, also known as a QI, that's what we are, is crucial as well. We hold the funds when the relinquished property closes, and this allows the exchanger to not take constructive receipt of the funds. It's essentially just the way that it goes, the tool that's used to defer those capital gains. You want to make sure you incorporate proper language into the purchase agreement. We send out a notice of assignment every exchange we do that notifies the buyer or seller that there's an exchange happening. This is essentially the purpose of including that exchange language in the purchase agreement. So we always suggest to include that exchange language in the purchase agreement, but if it's not included, we have that notice of assignment that we send out as well, just to make sure our bases are covered. And finally, evaluating replacement property options prior to selling your relinquished property. This is crucial because, as we'll kind of get into in a slide or two here, there are timeline requirements with 1031 exchange. When the sale of your relinquished property closes, you have 45 days to identify and 180 days to complete your exchange. So really going in ahead of time, looking at replacement properties and seeing what you'd like to purchase, or at least knowing what you'd like to purchase, that can speed that process up and make sure that you don't get pushed up against that boundary. The rule of a qualified intermediary in a 1031 exchange, kind of as we mentioned earlier, is to make sure that either that exchange language is in the PSA or that the seller or buyer receives a notice that there's an exchange occurring. We hold the funds, that third-party escrow, the funds come to us. That way there's no constructive receipt by the exchanger. We notify the exchanger of the timelines, provide notifications, and check in if we feel like they're entering a situation they might not want to be in. Identification management, we provide the rules surrounding identification. So we explain those to the exchanger and make sure that they're aware of what they need to do to make sure they properly identify replacement properties. And when it comes to legal and tax guidance, what we do is really explain the rules and regulations that are there. When it comes to each exchanger's personal tax and legal situation, we suggest that they, and it's really their responsibility to acquire legal and tax guidance and make sure that they're, within the guidelines, basically. So the 1031 exchange process, this is just kind of an overview of kind of how everything works in the 1031 exchange. Essentially, the relinquished property is sold, funds come to the exchanger, we hold those. We ensure that replacement properties are properly identified. Once those properties go into escrow, we release funds to purchase those replacement properties. And once all funds are out of the exchange account and all properties have been purchased, the exchange is then closed. This is the timeline I mentioned earlier. So you can see here at day one, you have the sale of the relinquished property, and at that point, identification starts. So you have 45 days from the sale of that relinquished property to go out and identify replacement property. In terms of what's needed for identification, this is typically just an address. In some cases, such as DSTs, slightly more information is needed. But ultimately, what you want to do is make sure that you have a legal description of the property that you intend on purchasing. The 180-day rule, so that just means that you need to complete your exchange within 180 days of the sale of that relinquished property. So if in those first 45 days, you can identify properties, you then have 135 days, 180 days total to close on that replacement property identified in the first 45 days. So within that identification, there's essentially three rules that are used, and these need to be followed in order to make sure that property is identified. The first rule is called the three property rule. This allows you to identify any number, any value of property. So you're limited to 3 properties in total, but those properties can have any value associated with them. So let's say you sold $1 million property, you can go in and identify 3 properties, each worth $3 million, $9 million total. The 200% rule, this is kind of the rule that you'd use if you wanted to identify more than 3 properties. In this case, you're allowed to identify any number of properties, but you're limited to 200% of that original sales price for your relinquished property. In practice, you sell a property for $1 million, you're allowed to identify, 5 or 6 properties, but you want to keep the overall value of those properties under $2 million, which is 200% of that original sales price of $1 million. The 95% rule is used very infrequently, but the way that rule works is it allows you to identify an unlimited number of properties at an unlimited value. However, you are required to purchase 95% of what you have identified in order to satisfy the exchange. If you do not do that, you could potentially disqualify the entire exchange, and that's why this rule is used less frequently than the other 2. So here we'll just go into the 1031 exchange benefits and essentially how that can benefit the exchanger. So we've already kind of spoken to this. Tax deferral, essentially a 1031 exchange allows you to defer all taxes, or can allow you to defer all taxes, including those related to federal, state depreciation recapture and net investment income. This allows, the exchanger just to keep their capital whole as they move through the process of selling and purchasing another investment property. And for this reason, it's one of the most advantageous strategies you can use to preserve wealth. So understanding the tax components is important part of any 1031 exchange. Obviously, the 2 largest taxes are going to be state and federal tax. State taxes tend to vary. California and New York seem to have the highest tax brackets that I've seen, and some places have very low tax brackets, Florida and Nevada. Federal taxes, on the other hand, affect us all. And, you can see, I think we'll move on to the next slide, but you can see that these taxes can make a significant difference in what you can purchase after selling a property. There we go. So here we have scenario A. We have an exchanger who sold and paid the taxes. You can see they ended up paying a total of $697,800 in taxes. This is off a sale of $1,800,000. That's a significant tax bill, right? That's a little over 30%. So if you have scenario B, they did a 1031 exchange. They were able to defer all those taxes. You can see they were able to preserve that capital much better. So another benefit of the 1031 exchange is that it allows you to reposition your real estate portfolio. And I think this is one of my favorite benefits of the 1031 exchange. We often have exchangers who maybe they're getting older or they inherited a property they didn't want. Whatever it is, the 1031 exchange allows those clients to shift their portfolio into something that makes more sense for them, whether it's an investment that takes less time to manage, or they're not happy with the asset class they currently have and would like to move into a different one. 1031 exchange will allow that to work. So you can see here, you want to defer paying taxes, you get greater purchasing power, you potentially improve your cash flow depending on what you're switching into. Ideally, I think you'd want to improve your cash flow every time. And it allows you to diversify, consolidate, and expand into other real estate markets. So I'll pass this on to Ehud here. He'll talk to you guys a little bit about Delaware Statutory Trusts.
Thank you, Juno. And yes, it's what Juno was talking about is really critical for people to understand because before we even get to Delaware Statutory Trust, many people have misconceptions about 1031s and their rules. So it's good that an investor that's looking to do an exchange, it's very important that they understand that and that they're working with someone, a QI. Obviously, we like Genesis, so if they're working with Genesis, you have a team that can advise you and has experience in advising and has done a fair amount of exchanges. So before I get into the DST specifically, there's two primary ways today that someone can do a 1031 exchange. And the first one is you sell your property, you go out, you find a real estate broker agent to help you, and you buy another property directly. That means that you typically, if you have debt, you need to go and secure that debt for a loan from a bank to buy that new property. And you also have to do your own due diligence. You have to go out, find property. That can take time, and do your own due diligence, your own underwriting to make sure that that's a property that you feel comfortable investing in. And that's all fine, but keep in mind, like Juno was saying before, under the rules, you really, even though technically you have 180 days to close on that property, you really only have 45 days to identify the property or properties that you're looking to invest in. And that puts a tremendous amount of strain and stress on investors, because unless you've lined up something ahead of time and you know that you're going to close on it, if you're within your 45 days and you're getting close to the end of that 45 days and you're not 100% certain you're going to close on that property, once you're on day 46, you can't make any changes. So if that sale doesn't happen, you're going to have to pay taxes. So the Delaware Statutory Trust is an alternative option. It's another way to invest. And it has many benefits, but I think one of them is the fact that it really reduces the gray hairs and the stress that many investors feel if they were going to go out and buy a property directly themselves. So before I get into the DSTs specifically, what is a DST? So it's an acronym. It stands for Delaware Statutory Trust. It's a business trust that is used to hold real estate. It doesn't have to be real estate, but nowadays it's primarily used for holding real estate. And as an investor, once you invest in a Delaware Statutory Trust, you become a fractional owner, a beneficiary of that trust. So for example, if you're a beneficiary under a trust, then there's a trustee that manages that trust on your behalf, and you're the beneficiary of that. So the trustee has certain obligations towards you as a beneficiary. So it's the same sort of situation here with the Delaware Statutory Trust. So you invest in a DST, it's professionally managed for you, and you are the beneficiary of that trust. The DSTs have been around essentially since the 80s, but it wasn't until 2004, which is 20 years this year, that the IRS blessed DSTs as a valid and legitimate way to do a 1031 exchange. And that's really a big decision, because what it's now allowed is for people to invest in DSTs and given them more options than they would otherwise have. And so that revenue ruling is 2004-86. And in the last 20 years, we've seen quite a bit of an uptick in 1031 exchange investors that are investing in Delaware Statutory Trusts as part of their 1031 because they're learning about it. And there's many people that still don't know about it. That's one of the reasons we have these webinars, is to educate people, but many people have never heard about it. Many CPAs, real estate brokers, attorneys have never even heard about it. So we spend a lot of our time educating folks about Delaware Statutory Trust and some of the features and benefits that come with it. So what are some of the advantages of a Delaware Statutory Trust? Well, the first one is it's a turnkey replacement property solution. These are properties that have been bought. They've already been acquired, so there's no risk of closure on the property. It's already owned. Typically, it's very rare that the property hasn't yet been owned. Already owned. And investors can go into it, and there's absolutely zero management that they have to do. So for a lot of folks, especially if they've owned real estate for 30, 40, 50 years, and they don't want to deal with tenants anymore, they don't want to deal with the hassles of management, This is professionally managed on their behalf. They don't have to deal with the tenants, the toilets, the trash, the termites, nothing. You don't have to deal with any component of that. And also for people that, like Juno was mentioning before, sometimes people inherit real estate and they just don't want to be bothered with the management. And the Delaware Statutory Trusts are typically managed by very large institutions. So these are professional real estate companies, very large most of the time, and usually managing billions of dollars worth of real estate. So you're not just handing over the keys, so to speak, to your investment, you're handing it over to companies that have got a lot of experience. And, one of the other benefits is the type of real estate that you get with Delaware Statutory Trusts. So using the example, if you were going to go out and buy a property direct, if you sold your property for $1 million and you go and buy something direct, it's highly unlikely you're going to buy something that's north of, let's say, $10 million for the vast majority of people. So you're typically going to go from $1 million property to maybe 1.5, maybe $2 million, just, statistically speaking. But with Delaware Statutory Trust, you can go into the same sort of real estate that the large institutions go into, like pension funds, like endowments, that allow you to go into the quality of real estate that it's virtually inaccessible to most people. And what's even more amazing about it is that you can get into this type of property for a minimum investment of $100,000. So if you are someone who sold a property, for example, for $1 million, and you're looking to invest in DSTs, you could technically go into 10 different DSTs because each one only requires a $100,000 minimum investment. And that goes to the third benefit, or the fourth benefit I was going to mention, which is diversification. We all know about diversifying our stock portfolios and our investments. We're told, from a very young age to, make sure you don't have all your eggs in one basket. Well, if you sell a property and you buy direct, you're taking your entire, all your funds, and you're buying only one property. With DSTs, because the minimum is relatively low at 100,000, you can diversify your investment. And while you're not eliminating your risk of investment, you're mitigating that risk because you're spreading out that risk over multiple properties. And typically you can spread it out over multiple asset classes like multifamily, senior housing, oil and gas mineral rights, industrial, self-storage. I mean, triple net, anything you can think of essentially in commercial real estate, you can invest in. And so if you were to diversify in that way, if something was to happen in a particular asset class, or even for a specific investment that you made, it's not going to create such a major problem for you if one of those doesn't perform, as opposed to investing in one property. If that property doesn't perform, that's a bigger problem because now your entire investment is at risk. The other great benefit of DSTs is sometimes we have folks who are selling a property and they have debt on that property. Juno mentioned before, as one of the rules of 1031 exchanges, is that you have to replace the debt when you're doing a 1031 exchange. So you don't have to replace it with debt, but you'd have to replace the value. And where interest rates are today, and securing a loan is much harder. Many people find it more challenging to get a loan. So if they're selling a property for $1 million and they have a $500,000 loan that is going to be paid off, in order to fully defer, they're going to have to buy a property that's $1 million or more in order to fully defer. Well, you only got $500,000. So that means you're going to go and have to get probably for most people, have to go out and get a loan from a bank. The challenge is that you only have 45 days to identify. So you have to secure that loan within a fairly short amount of time, and that's assuming you can even get the loan to begin with. With DSTs, that problem is essentially solved. The reason is because the DSTs, some of them come with debt already on the property. So that debt is not in the name of the investors, it's in the name of the trust, in the Delaware Statutory Trust, and the investors are not on the hook for that debt. It's non-recourse to them, which means that if that debt is not paid, they're not obligated to pay the lender. So it not only solves the problem of having to replace the debt if you're selling a property that has debt on it, but for many people as well, if they sell a property that has no debt, and meaning they can, and then they've run out of depreciation, for example, right, to be able to shelter some of the income that property is generating. sometimes they want to go into a property that has some debt on it because now they're increasing their depreciation schedule, which helps them shelter the income that they're generating from the DST. So you're not on the hook for the debt. You don't have to pay it if something goes wrong with that debt. You use it to replace the debt that you need, and you can also use it to increase your depreciation schedule if you'd like, in order to shelter more of the income that you're receiving. So a lot of benefits just on the debt component. And then, one of the other benefits, of course, is estate planning. Whether you are, let's say, going through a divorce, where, a couple separates and they no longer want to be together, if they sell that property and they don't do a 1031 exchange, they're going to have to pay the taxes. Whereas they could agree to sell the property that they jointly have, invest it in multiple DSTs, and then have an agreement that, each one of the couple is going to get different DSTs as part of the marriage dissolution agreement. It's also good for people, let's say you're in your 80s or 90s or not even that old, that you've got several heirs or several people that you want to leave your assets to, but you know that if you leave one asset to them, it may cause a problem. And I've seen this multiple times where you have grandparents that have owned one piece of real estate, and they're concerned that, they've got, let's say, 3 grandkids, that if they leave that one piece of real estate to those 3 grandkids, those grandkids are not going to be able to agree on what to do with it. Maybe one of them wants to sell it, one of them wants to keep it, and it potentially leads to disagreements. So what they can do is they can sell that property, go into, let's say, 3 different DSTs, and every grandchild gets their own DST as part of their inheritance. And that's just, the tip of the iceberg and what can be done in terms of estate planning. So there's a lot of benefits to DSTs, and the idea behind them is to make things simple for someone who's doing a 1031 exchange. And I don't think there was one other point. Oh no, I did say low minimum investment. So moving on to the next slide, what are the restrictions and limitations? So it's important to remember that DSTs, on one side of the coin, they're 100% passive. You don't have to take care of any management. But on the flip side of that, you're really relying on the DST sponsor. We call them sponsors. It's really the companies that manage these DSTs. You're really relying on them doing a good job managing your money, managing the asset that you've invested in. So people have to feel comfortable with giving up that control to know that they've invested in a company that is going to take care of their investment. And at Perch Wealth, at our company, we spend a lot of time vetting these sponsors. And really, the sponsors are probably one of the most important factors to consider when investing in a DST, because you want to know their track record. And even though they've performed well in the past, you want to really understand how they manage themselves, what sort of assets they typically acquire. And during COVID, it was a really good litmus test, because it really gave you an idea of, how some of these sponsors perform when you have sort of a black swan event where things are not going that well generally in the economy. So you're giving up control, and DSTs are not liquid. It's still real estate. So in and of itself, it's not liquid. But once you invest in a DST, the typical time frame in which you're going to be in that investment is typically and historically around 5 to 7 years. So you have to be comfortable with being in that investment for 5 to 7 years. And even though it's legally permissible for you to sell your DST investment to someone else that's ready and willing and able, there's no official secondary market. So you'd have to find a buyer. And if that was a situation that came up, at Perch, we could help you try to find someone that might be interested in purchasing your interest, but people shouldn't rely on it. They should understand they're going into a DST, they're going to be in there for anywhere from 5 to 7 years. And also the decision of when to sell the DST is made by the sponsor. So the sponsor will typically decide, let's say in year 5 or 6, that they're going to sell the asset. At that time, the asset is sold. Investors will typically receive a notice maybe 90 or 120 days before the asset is sold. And the sponsor will tell investors, if you want to do another 1031 exchange, let us know. Please let us know you're qualified intermediary. So that time, you can let Juno at Genesis know, okay, we're going to be doing another exchange. And then at that point, if you want to do another DST, you have the option to do that, or you can buy direct, or you can cash out. So you have the exact same options you had when you originally invested in the DST. The seven deadly sins, you can read it here on the screen, but one of the things when the IRS came out with the ruling in 2004 saying that DSTs were a legitimate vehicle for doing a 1031 exchange, they also listed some limitations on that. And one of them is that you cannot do, if you're the sponsor, the company that's managing these DSTs, you're not allowed to do a capital call. What that means is that if I've invested in a DST, let's say I've invested $1 million in a DST, the sponsor is not allowed to come back to me, let's say in a year or two, and say, "Who we need more money. We didn't manage our projections correctly. We need you to come up with more money." So that cannot happen. They're not allowed to do that. You're also you're not allowed to make repairs if they're major repairs. So you're really, it's really limited to minor repairs, things like that. And that, these things really go back to the sponsor themselves. So when we look at a sponsor, when a new offering comes out, a new DST offering comes out, when we're doing our underwriting and due diligence at Perch, one of the things that we're looking at is what are the projections and what are the business plan, and do they make sense? Because if they haven't set aside enough money in reserves, or the business plan doesn't make sense to us, that's typically a red flag. So, because you can't do capital calls, because you can't do any significant major repairs to the property, because you can't refinance the debt, those are significant things that need to be planned for ahead of time. So we want to make sure that the sponsor has planned for it adequately. And again, at Perch, because the minimum, like I said, for DSTs is $100,000, when we have a client that's interested or potentially interested in investing in a DST, we will build out a custom portfolio for every client that's specific to them, because every person is different. And so we might have, this is an example, we might have a recommendation to invest in multifamily, assisted living, triple net, self-storage, but ultimately it's the investor themselves that makes a decision how much and in what to invest. Our job is really to act as consultants, advisors, to help you navigate this potentially, for most people, this new area. And this is another example of what the DST sample portfolio might look like. So you see the asset type, the different sponsors, the amount invested, projected income for the first year. And so this gives a visual to investors to see how a portfolio might look. So they've gone, for example, from owning a $1 million property to now maybe they're in 4 different DST properties. And so it gives them a nice visual. It shows them in what asset classes they're looking to invest in. It shows them the geographic locations. And yes, that's essentially the DSTs. And of course, if anyone has any questions, we're always happy to answer. And, I touched a little bit about the real estate environment today. As we all know, interest rates are high. And, that really speaks to the debt replacement. And also, it's a very tough market to find replacement properties. If you're buying direct, it's very difficult to find replacement properties that match your criteria. There's actually a lot of demand in the market right now, and many sellers don't want to sell because many of them have locked in very good rates, maybe 3 or 4 years ago, and they're not interested in selling right now because they know if they sell, they're going to have to potentially pay a lot more. So there is a lot of demand out there from buyers that are looking for quality assets, and the DSTs really solve that problem because you can get into some really good assets and you know exactly what you're going to be getting into. And that's it. I don't have anything else. I want to thank Juno and Balaji. We love working with you guys. And
No, it's a pleasure. We appreciate the opportunity. You're a great partner to us, and thank you. And thank you for the opportunity to do this together.
Likewise, Ehud, it's been a pleasure.
absolutely. Thank you, gentlemen. And we'll talk soon. And if anyone has any questions regarding their exchange, definitely call Juno and Balaji. You're in very good hands. And if you have any questions about DSTs, you're welcome to contact me at Perch Wealth. Our website is perchwealth.com. And thank you, everyone.